Hey Brian, how's it going?
Good, man. I made it in.
There you go. Sometimes that happens with those links. Not sure. Sometimes you click on it, it works perfectly. Sometimes it just,
Uh, that was it. I had two links. One had me register. Another one was a direct link to the meeting, but it said that meeting hadn't been started yet. So that one didn't work. But I think when I registered and I just literally got the email from the registration. So I think that's what did it.
okay. I just sent you one as well. So hopefully,
All
either
right.
way, we're happy to get
We're
you on.
here.
I think we're wearing the same shirt today too.
That's how it is, man. We had to coordinate.
You got it. So how's it been? This is an interesting, there's like headlines every single day of a new syndicator or operator having problems. Do you want to just jump into it or like a catch up of what Praxis is doing these days? Whichever way you want to go.
Oh, we can do anything you want. This is your event and I'll follow your lead. So we can jump right into a discussion on that or a discussion on what we're doing. I started selling aggressively a couple of years ago. So I made it mostly out of the market right at the peak. So I can talk about that. And I can also talk about what I'm seeing out there. And you're right, there is some groups out there are having some trouble. So we can certainly touch on that as well.
So what I don't want to jump to conclusions. I know most people that signed up to this webinar do or know of you and your reputation, but for the ones that don't, do you want to just give like a high level intro to Praxis and yourself?
Yeah, for sure. Are we live now and ready to go?
Yeah, we're
This is
already.
it. All
Yep.
right, good stuff. Yeah, so for those of you who don't know me, I'm Brian Burke. I'm the president and CEO of Praxis Capital. I've been investing in real estate now for 34 years. I've been the principal of Praxis Capital since I founded it 22 years ago. I started out as a house flipper. I've flipped over 700 houses. I think I'm approaching 750 or somewhere, maybe even over that. About 20 something years ago, got into multifamily. Multi has been a big part of our business, and now it's the main part of our business. I've bought over 4,000 units, but I've sold over 3,000 of those units. I only have about, I think maybe I've got 800 or 900 units left right now, which is a pretty feel good place to be, I must admit. So during my career, I've bought over $800 million in real estate, raised over 300 million from passive investors. I felt that experience gave me enough knowledge to write a book. So I wrote one about 3 years ago called The Hands-Off Investor. It's an insider's guide on investing in passive real estate syndications, written for the passive investor to teach them what to look for when investing in passive real estate syndications.
And just a plug, Brian's book is like a must read for any limited partner, even the operator. It should be both, especially if you're a newer operator. It has all the questions you need to be asking, and it has tons of red flags that you should watch out for when you look at a deal. So everybody who hasn't read that book, and I know so almost everybody in my network has read that book, but if anybody hasn't read the book, make sure you pick one up. It's one of probably Bigger Pockets most, I think one of its most like meaty and packed for punch informational books in the series.
That's probably why it's their worst seller. Everybody wants to buy give it to me in 10 pages and give me an overview. And then after they read it, they go, well, that didn't tell me anything. This book will tell you everything you need to know if you're investing in passive real estate syndications. And if you're doing passive syndications, it's really good to know what your investors are looking for, right? You want the answers to those questions just as much as they do.
Yeah, and one of the funds that we have is the income fund. We invest with Praxis, and what he puts into his books is also what he does on his quarterly reports. I consider them the gold standard in reporting. I think compared to other deals that we are LPs in, it's head and shoulders. And I try to emulate you guys of what you guys do with how thorough you guys are. It's almost like a little report card on every single property, and you guys are very transparent, truth to things. So anybody who wants to see a good investor report, talk to Brian. He does what probably hands down the best report in the business.
It's very flattering to hear. We put a lot of effort into those, so I'm glad to see that effort is translating well.
Yeah. So tell me a little bit about what is Praxis transitioning. I feel like we're in this lull where 6 months ago we were like, oh, the recession's coming, foreclosures are about to come in. There's going to be a wave of them. 5 months, same thing. 4 months, same thing. It's forecasted for the next quarter, but it might be slower, it might be 2 quarters, depending on who you listen to. What are you guys seeing, and how are you guys approaching the next, let's say, 6 to 12 months?
Yeah, if anybody was listening to me a year ago, they weren't expecting a bunch of foreclosures or a major recession to happen this year. It's too slow. Real estate is like a battleship, and trying to turn it around just takes time. And same thing happens in times like this, where if you're waiting for foreclosures, it's going to be a year before the first shoe drops, before you really start seeing the other shoe starting to drop. Yes, we've already seen some major foreclosures. Everybody's probably read about the 2,000 units that was foreclosed in Houston. You're going to get some of those that are going to come out early on, but to see any quantity of them is just going to take a lot of time. I think lenders are going to try to be flexible with borrowers and try to prop deals up and save them and kick the can down the road and hope and pray and all that kind of stuff. But eventually it catches up. Interesting statistic I read recently, there's $500 billion in real estate debt in the multifamily sector that's maturing every year for the next 4 years. So there's $2 trillion in debt, and it's $500 billion every year. And it isn't so much really the trouble that I'm seeing mostly out there is dealing with current cash flow. The trouble is dealing with maturities, because a lot of groups, they over leveraged, they have too much debt, the debt's coming due, they can't refinance without injecting cash. They're having difficulty raising cash to make that cash injection, and then they get stuck. Their back's up against the wall. And that's when they're stuck and there's really nowhere to go, that's when the lenders are going to start putting the screws to them, and you'll start to see more foreclosures. And that's just going to take a while, and it's going to last a while, I think. So is there going to be a recession? Yeah, I don't know. Jury's still out on that. I sure wish there would be. I'll tell you that. A recession would, I think, help out a lot for commercial real estate owners, because it would put an end to this ridiculousness that the Fed's playing with interest rates.
Yeah, it's so many good points you just made. One, I feel like in the last couple of months, I've been hearing a term that I've never heard before, the refi in term.
Cash
And
in
it was
refi.
like, yeah, all of a sudden overnight, it was like, oh, there's this new term out there. And I heard it on one podcast, and then all of a sudden it was like wildfire. I just kept hearing like, that's a good thing if your operator has the capital and I guess the brand loyalty, where he can do basically, it's just a nice way of really saying a capital call in one way or another. But if you could say it and actually get it done and save and buy yourself time, that's what you're really doing. You're buying yourself time for the next 3-5 years, whatever it is. That's great, but you're going to see a disproportionate amount of the newer operators who are in that boat, and they just quit their W-2 and they're posting all over social media about how they quit their job in 18 months and became a big operator. But there's no chance those guys can do a refi in. So it's definitely an interesting place in the market today. And hopefully it gets a lot of, I don't want to say like a newer guy, like I don't have your 30-year track record, but it would like be a good thing, like you said, almost like a recession. And it'll get a lot of newer operators that weren't really in a position that really should have been operating to get out of the space as well.
Yeah, this definitely separates the proverbial men from the boys kind of thing. It's times like this where good operators are going to rise to the surface. And when you have these kinds of things happen, the groups that survive this are the ones that are probably going to survive longer term. And those are groups you should really be thinking about when you're looking to make passive investments. And the groups that don't survive, and there's going to be a number of them, are probably ones that never should have been in the business in the first place, but conditions were ripe enough. It was easy enough to raise capital that people with no track record and no experience were able to accomplish it. And kudos to them for actually being able to get that far. But these kinds of events happen, and it makes it really difficult. It's easy to fly a plane in the sunshine, but when you're doing it in a storm, it requires a little bit of finesse and experience.
And you are a pilot, so that's like a reference with a little disclaimer right there.
A real world example. That's right.
Yeah. What do you think of the recent 2 months of headlines, right? There's not to say that their strategy is wrong or not, but there are a certain type of heavy value add strategies that are getting in the mud right now. And some of the publications like The Real Deal, and I'm sure you've seen them. What do you think about when you see those articles? 50% just outlandish, but then it's 50%. I'm like, wow, these guys are really going heavy on the gambling by being in debt service of 0.8 when they're buying the property. What do you, someone who's in it for 3 decades, What do you like? Would you ever feel comfortable like practice going in on a point 0.8 like debt service and just expect like a $400 or $500 rent bump? Or what is your take when you read like headlines like that?
I've actually done it, and I did it in a recessionary time. In 2011, we had a deal just like that where we bought a foreclosed multifamily property. I think it was 54 units or something like that in Austin, Texas. And it was in really rough shape. It was 70% occupied. The rents were super low. There was a shooting in the parking lot just before it was offered to us. Like everything was going wrong. And we bought that thing super cheap. But people are going to shit when they hear that I bought 54 units for 800, or no, yeah, 800 grand. Yeah, 800 grand for 54 units in Austin, Texas. Now that's a fourplex. It was a time when nobody wanted to buy real estate. Everybody was afraid of it. And there's arbitrage plays will work in any environment. You can do those in up times, down times, sideways times. The trouble, they're few and far between. And so when you see these kinds of arbitrage plays, especially in a market where real estate's still fairly sought after, you always have to question whether the opportunity is real or if it's an overly optimistic sponsor. Are they overshooting the rents and where the rents really are, or do they have really solid comps? Did they really negotiate a real discount, or are they paying above market value? That's where it gets highly suspicious. You don't see a lot of really good heavy value adds in times like these. If you can find one and the numbers are real, they can be incredible opportunities. It's just they're rare.
Yeah, and to your point, it sounds like you bought like a Class C property and probably changed it to a Class B. These operators that I think are getting slinging on, they're buying like Class A minus B plus properties, and or let's say Class B. I don't want to miscategorize them. And then they're still going into those debt service coverage ratios. So to me, I get uncomfortable looking at it as an investor. Obviously, it could still work, but to me, to see, yeah, you could get the 15 to 20% IRRs, but I don't think you're taking a fair amount of risk reward on that when it's that type of value proposition.
In times like this is especially the time when I'm more looking at what the downside risk is rather than the upside potential. There's times when you can lean the other way, like 2017, 18, 19. You could look at upside potential a little bit stronger than downside risk because there wasn't a lot of risk factors that seemed plausible at the time. But now there's risk everywhere. There's risk of interest rates, there's risk of rent declines, there's risk of occupancy challenges. You're seeing a year-over-year rent decline data on a national basis. You're seeing record deliveries of new construction. We're starting to see in our own portfolio increased concessions just to maintain occupancy. So you're competing with not only newer product, but also similar vintage product that's having to offer concessions to maintain their own occupancy. And so it's hard to get $500 rent bumps when you got apartment complexes down the street giving away a month's free rent. There's just a lot of risk out there, and you got to keep that in mind when you're doing these kinds of heavy value adds. So right now, like I said, there could be one of those needle in a haystack out there, but if you're seeing a lot of them, I would question how many of them are real.
Gotcha. I think that's a, hold on, that's a good like transition point. Are you guys actively seeing, are you guys actively looking for deals right now, or are you just letting it play out? Or you're underwriting the deals and you're just too much of a gap?
Yeah, it's the last of those options. We're underwriting. We're not under any delusions that we're underwriting because we're seriously thinking we're going to get the deal, but we're underwriting. You have to stay in touch with the market to really understand the signals the markets are giving you. So for us to just sit completely on the sidelines would be counterproductive. We did that for the first half of this year, and the second half of last year, we basically full stop sat out. Didn't underwrite deals. If I get a deal in my inbox, I'd just delete it. It wasn't even worth looking at. But earlier this year, we started underwriting. Now we're underwriting most of the stuff that we see. But the bid to ask spread is astronomically wide, and it's achieving a gap is just unachievable. Closing that gap is just unachievable right now in our experience, what we're seeing.
Are you guys tweaking, like right now? I know basically any deal with conventional financing isn't working, right? Because you're looking at rates, let's say between 6, 7%, whichever agency loans you're going to be in. We are shifting and say, hey, let's go for smaller deals, but try to do all cash. And then we'll wait it out. Interest rates really don't matter in that situation. And then not to say that you're guaranteed a refi, but if you're going in and you're paying all cash, you're guaranteeing a refi in 2, 3, 4 years, as long as the rates, even if they still stay at 6.5 or whatever it is, you can still almost guarantee a refi at that point. Are you guys tweaking your buying strategy at all at Praxis?
Not really. I agree with your findings about smaller multifamily. In fact, I've been saying for about the last couple of months at conferences and podcasts, and I did one earlier today, same discussion. Like, where's the opportunity today? Today, the opportunity is probably in smaller multifamily. I think that's where you're more likely to find bargains because you have the quintessential tired landlord, you have the undercapitalized owners that are up against the wall. You're going to see more of that there than you're going to see in larger multifamily, where the owners tend to be better capitalized, more professional. This is their primary business, that sort of stuff. But I've already been through the smaller multifamily phase of my career. I don't really want to go back there. And we don't need to do deals. So right now we're not. And that's just, it's a privilege that I'm very happy to have, but I wouldn't say that's for everyone. So we're not currently buying at all. And I think it makes sense to talk about buying in cash and doing a refi later when the debt is more cost effective, as long as the numbers work under assumptions that the debt isn't going to get that much more cost effective. Because we really have to wonder where debt is really going to be priced 1, 2, 3, or 4 years from now, and be realistic about that. I have a sense that interest rates are going to be higher for longer than a lot of people think. And so eventually what's going to need to happen is there's going to have to be cap rate decompression in order for deals to make sense with the real cost of leverage. And I think that's part of the reason why you're not seeing a lot of deal flow right now. Sellers don't want to sell because they're thinking, oh, I'll wait to sell when rates are better and I can get a higher price. Or they're saying, you're thinking rates are going to be better soon and conditions will be better soon. And if they're not, they're going to have to come to grips with, okay, it's time to sell. I need to sell. I have to sell. I want to sell. And this is where debt is priced. So I have to price accordingly. And that's going to impact their transaction value.
Yeah, and if you just think about like timeline where we are today, right? We're in 2023. Most of the deals that are going to market in 2023, let's say it was purchased 18, 19, 20. What are the rates back then? And then if you underwrote it, let's say a chapter out of your book, right? 10 basis points, let's say, of compression a year, you're nowhere close to getting a deal done today.
That's
like
right.
You're miles away. And it's like almost like you need those deals to have some kind of conclusion, almost like a resolution. And then the next batch of deals, like the deals that are being bought today at rates of 6, 7%, they're going to be fine in 2, 3 years to sell, even if the rates are 6, 7%. It's like you could buy apples to apples. It's just the deals now are almost like it's apples to oranges from what they were 3 years ago to what they are today.
Yeah, and I would even say deals bought in 17, 18, 19 might be okay as well, just because they've probably had substantial NOI growth. When rent increases post-COVID, depending on where they're located, they may have experienced some really robust rent growth. And you could have a situation where the NOI growth outpaced the deflation effect from a decompressing cap rate. So they won't make what they thought they were going to make, but they could still make a positive return. But the deals that were bought in 2020, 2021, 2022, those are the ones that are probably at the highest risk because they haven't had a chance to see that NOI growth yet. And they missed the COVID bump. In fact, they paid a premium for the COVID bump that the previous owner got. And they may not have the NOI growth to balance off against the cap rate decompression. And when you think about going from a 4 cap to a 6 cap is a 50% decline in value. So it's a substantial hit.
Do you think this changes the industry a little bit? Because I would say 2021, 2022, almost every pro forma I saw was a 3 to 5 year pro forma, right? Like
Yeah.
you saw, I didn't agree with most of them, but it was a 3 to 5 year pro forma. You see the 18% IRR, let's say. Do you think this shifts it, like where people can't project the 3 to 5? They're going to be projecting. I haven't seen it as right because it's harder to get the higher IRRs when you do a 7 or 10 year deal because of the effect of time. But do you think this will have an effect in how many deals come out there that are projecting out to that? It's going to shift. The threes are going to go to the fives, and the 5 year business plans are going to go to the sevens.
That's a great point, but probably not because people don't tend to learn very easily. They'll repeat their mistakes. I think in part, a deal that's bought today could have, I shouldn't say that. Today it's anybody's guess. Today is just absolutely the Wild West. But a deal bought a year from now, there's a realistic path to having some interesting performance in a 3-year horizon, assuming that they have a viable value add strategy where they can bump the income and sell in year 3 and so on, not have a lot of cap rate decompression because that was all in the rear view mirror. I could definitely see that. I think if you're buying something today, you would really need to have a 7 to 10 year horizon because you really have to get to the other side of the next market cycle peak, so to speak. If you buy something today and the value goes down 20% over the next year, and then it goes back up 10% a year for 2 years, you're 3 years in to get back to even. So you're going to need years 4, 5, 6, and 7 to really produce fruit to give a return that's palatable.
Got it. And in terms of, let's relate it to Praxis. I know the first talk I've ever seen you give was like reverse underwriting, and you start with the end in mind, and you usually always, I remember this, you always say like you maximize the IRR like in year 3 type of thing, and it always made sense. And I know that your debt aligns to that. That's like your vision with deals. Is that still the same? I know you said if you buy next year type of thing, but are you underwriting today for a 3 year hold? What is the way you guys are discussing it internally?
We used to underwrite our primary metrics to a 3-year hold. Now we're underwriting to a 5 because the next 2 years aren't really going to produce much. I think they're going to be pretty scattered. Right now, our base case is 5 years. It used to be our base case was 3 years. You do maximize your IRR in 3, in my opinion, because at that point, you've done pretty much everything you can do to the property, right? If you're going to go in and fix up units and enhance revenue and cut expenses and all the stuff that you do in a value add, you're going to be done with all that by year 3. So after year 3, you're really just relying solely on the market. Now, you could find a situation where you get to year 2.5 and there's like massive rent growth, and maybe you can hang on for another year or 2 and capture some additional upside where that might make sense to do that. But generally speaking, you're gonna maximize your IRR in year 3. But that's a lot of that is because you're doing a lot of things to maximize the income. Today, you may maximize your IRR in 5 because it's not just about maximizing the income, it's also about riding through this wave of this market cycle.
Got it. And in terms of, I know you guys are vertically integrated, you guys have your own property management in-house. What is the talks like because you guys, before you bought a property, a year later, 2 years later, you're almost in position to sell it. Like now the holds are longer. What are those kind of conversations are internally? Are you guys doing anything operationally different today versus, let's say, a year ago?
No, nothing substantially outside of just offering concessions to boost revenue. We haven't done that much, but now we're seeing that come into play a little bit more as we're finding the markets are softening. Obviously, we're always reacting to what the market is telling us on when we see softening, how do we counteract that and maintain the most amount of revenue possible. But we have a lot of different strategies that we employ for that, but we've been doing that all along. For example, we use revenue management software that basically uses AI to predict rents, asking rents out, or what we call street rents. When somebody walks in the door and looks at a 2-bedroom, 2-bath, how much are we going to quote for that rent? And that's going to be dependent upon occupancy for that unit type, forecasted occupancy, notices to vacate, evictions, all that different stuff. So you're balancing asking rents with occupancy to enhance revenue. But we've done that all along. But now it's really more important than ever, because it's really easy in a strong market to say, okay, when do we institute the next $50 rent increase? It's a lot harder to say, hey, when do we cut rents $400? Because we have to. That's a tough decision nobody ever wants to make. We let the AI make that decision for us, and it does a really good job because it takes all the emotion out of it. So I think that's probably one of the bigger things. But interestingly enough, operationally, our properties are actually performing quite well. We're holding on occupancies. We've been in some markets that have seen overall rent declines, yet our rents have held up. We haven't seen the increases we had expected to see. Neither has anybody else. So we're not unusual in that regard. There's not really much we have to do differently, but we are having conversations around, we got assets that we probably would have sold next year that we're unlikely to sell next year because we'll want to wait for stronger times.
And you brought up AI. I'm curious on what your feelings is. Like when I got started, I got into the crowdfunding age of real estate, and then it went from crowdfunding to where the conversation shifted over to tokenization was like a hot topic for a minute. And now it's AI is the hot topic of like how to use, and you start seeing some of these syndications come out and they're almost like advertising, like, oh, we're one of the first AI based. And to me, if I know how the crowdfunding thing ended up, it ended up pretty bad for me. So I thought tokenization had too many tax issues to be viable. And then it's all about AI. When you see that, what do you think when you see AI as it's almost like an AI company that does real estate type of thing instead of a real estate company that uses AI? Like, what do you think when
that's our category, right? So I think there's a lot of that hocus pocus stuff that none of that makes any sense to me. I remember the whole crowdfunding thing, and then I remember predicting the crowdfunding companies' bankruptcies, and then I remember watching crowdfunding companies go to bankruptcy and listening to people's stories about how they lost money in their crowdfunding deals, and I think like, saw that coming. So none of that was a surprise. The tokenization thing, that went right by me. I missed that one completely. I heard a couple words about it, but that was a flash in the pan. I think maybe there's going to be some future towards blockchain having some kind of involvement in real estate title. Perhaps I could see some of that, but I think all that's a long way off, in my opinion. AI company that does real estate, to me, that's just another fintech company. Disaster in the making. And we've seen all sorts of fintech companies raise a lot of money and then fail. Not surprising. Real estate's an old business. It's been done an old way for a long time. Everybody wants to find a new way to do it. And I don't know, to me, I'm just old. So the old way works. So why mess with it? The AI tools that we use is ancillary. It has nothing to do with our primary business. It's just simply a way to help speed up our decision-making process on how we price our inventory. And I think that's something that we've been using for a long time. It's not like we just instituted this when ChatGPT came out. We've been using this software suite now for, I think, about 3 years. And it's been around for even longer than that. We were a little slow to adopt it, I would say. I remember there was companies that had adopted it 5, 6, 7 years ago. And I'm like, oh, great, here we go. This is going to blow up in their face. And then it got tested and it proved itself. And we found that it actually was useful. But as you said, this is ancillary to the business. It's not the business.
Yeah, I think it's always bad when you look back and you say, well, that investment went bad because they couldn't do another venture capital raise. That is not what you want to say when you're investing in real estate. You're investing in real estate because it's buying a hard asset. I think when I was researching my book, like apartment buildings go back to like Roman times and thousands of years, actually the cheapest apartment because you have to walk up all those stairs. But it goes back thousands of years. So whenever they try to do a spin, and I fell for it with the whole CrowdStreet when I was starting out. But now whenever I see something like this, I try to warn like my investors out there and everything like that. If you're investing in real estate, make sure it's real estate. A lot of these tech companies, like they're tech companies. And right. You see what happened with the lending. I don't want to mention any names. There's a really big lending company that it was actually hard to even get a portfolio built up because they were raising so quickly. But it's like when you see that Silicon Valley, like the San Francisco headquarters address, they're like, wow, that's their, can you imagine their overhead and what they're looking at? That's not what you want when you invest in, you could run real estate out of an office, like out of your home office. You don't need like a big Silicon Valley or San Francisco address at that point.
100,000 square feet on the top floor.
Yeah. Yeah.
Yeah.
And then, so I just, to all the investors out there, just be careful when you guys see the newest thing, because it'll be something else in 18 months. And technology is so rapidly changing that just make sure that you're investing because of good fundamentals and nothing else.
Yeah, an old change in real estate was, I remember when they changed over from the recording the deeds, you'd have to look up the recorded deeds on a microfilm cartridge that you had to stick in a machine and fast forward until you got to the document you're looking for. And then it was a huge upgrade when they started scanning them and you could actually look at them on a computer screen. That's how much technological advancement has taken place in real estate. It's very slow to react and move to that kind of stuff. So I don't think that there's any big, huge changes coming down the pike anytime soon.
So Brian, let's shift over a little bit because I know a part of Praxis also does lending. What are you guys seeing like in the lending market with the rates being where they are now?
Yeah, that's a great question. I should say that we used to do lending and we sold that company a year ago. And that was an incredible exit. We sold it to a publicly traded company. We did $2 billion in real estate loan originations for house flippers, small balance commercial, small multifamily, and that sort of stuff. But I am still somewhat involved because we do have a fund now, a debt fund where we're not actually doing lending, but we're buying real estate debt. Actually, what we're doing is we're buying loans from our old company, the one that we sold to the publicly traded company. Now we're buying the loans that we used to be on the other side of the table, originating and selling those loans. Now I'm on this side of the table buying those loans from the same people. So it's an interesting turn of events. But what I am seeing in the debt side is debt's a little harder to come by. I know that when we get exception scenarios, for example, let's say somebody's approaching our former company to ask about borrowing on their multifamily building that they're going to buy and renovate and then refinance out of. Every once in a while, there's something that's not quite in the box about that loan, and they'll come to me to say, if we originate this loan, will you buy it, kind of thing. And I'm looking at a lot of them now and saying no. I want a little bit higher quality areas. There's always that chance that if we get that property back, I don't want some cast off in a really bad area that they threw this one overboard because they couldn't get it to work. That's not the deals that we want. We want solid borrowers with solid real estate and good business models. And 3 years ago, it was a lot easier to get those loans than it is now, I think.
Got it. And I think that's what I was referring. I didn't realize the debt fund purchased. I did see the debt fund. I didn't realize that the purchasing from your old company. So you guys do the Fannie and Freddie Mac like model where you buy like after it originates.
Yeah, that's right. Yeah, exactly. So and that's how we operated our old company is we originated the loan. And then after we originated it, we sold the debt to a loan buyer. Now we're the loan buyer buying it from the old company. So it's neat to be on the other side of the table.
Got it. Okay. So I guess we'll have a couple more minutes and then I'll open up to anybody. If anybody has any questions, feel free just to throw them in the chat or the Q&A and I'll read them off to Brian. So I guess in the immediate future, you guys are starting to re-underwrite. You guys started to re-engage underwriting and then you guys have the debt fund. Any other plans or anything else that you guys are looking at?
We're not. That's it. I'm taking a nice break. It's comforting to have a little bit more time than I used to have running 100 miles an hour with my hair on fire. We're not looking at any new lines business, any new business models or anything like that. I'm basically focused on our debt fund and I'm focused on monitoring the multifamily market to see if I can catch the first signals of when I think things are going to turn around and produce some opportunity for us on the acquisition side. My suspicion is it's going to be another minimum 6 months before we get there, but yeah, that answer could change next week.
Are you having conversations with the lenders or are you having conversations with the commercial brokers?
Both. Yeah, both. Yeah, I talk with our lender from time to time just to see what's the debt market doing. Because when we're underwriting an asset, part of that process is to plug in our debt assumptions. And that's going to affect cash flow. It's going to affect loan proceeds, how much money we'd have to raise for the deal, which is in turn will affect the IRR. Yeah, you have to stay in touch with what debt costs. And that's a moving target as well. And from two different fronts, interestingly enough, because on one hand, interest rates are moving, the indexes are moving. And on the other hand, the spreads, which is the layer that the lender is charging above the index, those are changing too. And just because the index goes up doesn't mean that the interest rate goes up. You could have a case where the lenders are the ones taking the loss and they're lowering their spreads to remain competitive. And you have to know what's happening so that you can plug in the correct assumptions into your model.
Got it. So I have a question from Chris. What have GPs learned about interest rate caps through all of this? And Brian, this is a good one because I think one of the things that when I was looking at deals for a while with all the interest rate caps, and now that I look back in hindsight, I would say 9 out of 10 of those operators didn't really fully understand interest rate caps. How do you answer this question?
I can tell you that I know I've learned a lot about interest rate caps that I knew theoretically, but didn't fully appreciate from a practical standpoint. So here's a few things that I've learned about interest rate caps. One is that when you buy your interest rate cap and interest rates increase, if you sell that property before the interest rate cap expires, the remaining period of that interest rate cap has a residual value that you can resell. And we made hundreds of thousands of dollars when we were selling properties over the last couple of years in selling interest rate cap residuals. So example, we buy an interest rate cap for 25 grand that was good for 3 years. We sell the deal in 2. We got 1 year left. We sold one of those caps for over $250,000. So it's a 10x gain with only 1/3 of the life remaining on the interest rate cap.
Wow.
So that's the good side of interest rate caps. Now, the bad side of before I get to the bad side of interest rate caps, another good side of interest rate caps is we have interest rate caps that we bought for 20 or 30 grand that are still in place on our floating rate debt that's paying us over $50,000 a month in payouts because interest rates have gone up. The rate cap is responsible for paying the difference between your strike rate and the actual rate. So we've got some that are paying 50 grand a month and we literally paid like $30,000 for that rate cap. And wow. So that's another good side of a rate cap. When interest rates go up, the rate caps that you've had in place are incredibly valuable, whether you keep the property or sell the property. Now, the bad side of interest rate caps, the worst side of it is not getting one. So there's a lot of groups out there that got floating rate debt with no interest rate cap, and they're fully exposed to the market, and they're really taking it in the shorts right now in additional interest that they're paying, and it's killing a lot of these groups. Not just the fact that it's sucking all the cash flow, that's one thing, and that's going to happen. But there's some where it's sucking the cash flow and then some, and actually sucking all their reserves, and now they're completely running out of money and their back is up against a wall. So those are really problematic and may result in some foreclosures or some lost principal on behalf of those investors. So that's a downside of not getting an interest rate cap. Interest rate cap is just basically like an insurance policy, right? That is insurance against interest rates going up. Now, there's also a bad side of interest rate caps when you do get one. And that is that when it expires, you're going to have to replace it. And when you initially buy the interest rate cap, you're buying it for a period of time. And when it expires, it's over and you got to get another one. So most of the time, people are buying 3-year interest rate caps. So you might have paid $30,000 for your 3-year interest rate cap when rates were at 2% and the interest rate cap was at 4%. And the company that sold you the interest rate cap was thinking, how long shot that we're ever going to have to pay out on this. Selling you that cap for 20 grand was a economical wise decision on their behalf until interest rates shoot up to 5.3%, which is where SOFR is right now. So if you've got a 2.5% SOFR cap and SOFR's at say 5.5%, that's 3% interest on your entire notional balance, which is your loan balance. And that's a lot of money. And so now when you get to year 3 and it's time to buy a new cap, the company that's going to be willing to sell you that new cap isn't going to sell it to you for 30 grand. They're going to look at, okay, if we've got to pay you $50,000 a month for the next, let's say 2 years, then maybe 30,000 a month in year 3, because that's where we think interest rates are going to be, that cap is going to be really expensive. And that's what's hurting a lot of deals right now, ours included, is that the lenders are going to force you to stock away capital for those rate cap replacements. And that's getting expensive. I'll give you an example of one of our properties. When we first bought it, the interest rate cap reserve was $500 a month. We just got a letter now that they're increasing it to $189,000 a month.
Wow.
That's like a 10,000x or something increase in the interest rate cap reserve payment. And that compromises your cash flow for sure. There's a downside. Ultimately, after the first 3 years of whatever protection you have, you're almost fully exposed to interest rate movement on a go-forward basis, because you're going to have to buy a cap that's realistic to current rates, and you're going to end up paying for it. That's the downside.
Does it change your sentiment on floating rate deals where you're like, going forward, we're just not going to do them? Or it's just, hey, this was a fluke of an 18-month period and it's unlikely to ever repeat itself, and floating rate has its place in the tool belt type of?
Yeah, I believe both of those answers are true, that this was a fluke. When was the last time anybody saw interest rates? Look at SOFR, for example. 2 years ago, SOFR was at 0.05%, 0.05%. Now it's 5.3%. That's about what, 1,010x movement in 2 years. No one that I was ever talking to was predicting that. And I don't think anybody saw that wide of an interest rate movement happening in that narrow of a period of time. So in a sense, yes, that is a bit of an anomaly. It's also the worst case scenario for a floating rate debt borrower, is to have interest rates increase rapidly in a short period of time, shortly after taking out your loan. That's like the absolute worst case scenario. And that happened to a lot of people, myself included. But it's also, it's part, in one sense, it's also part of the risk, but in another sense, the alternative to that fixed rate debt or floating rate debt is fixed rate debt. Now, let's first separate bridge debt from floating rate debt, because people often get those two confused. They're not one and the same. Bridge debt is a floating rate debt product, but it has a very short maturity. I've never been a proponent of those. Don't like them at all. They're kryptonite. Those will kill your deal. Floating rate debt with a long-term maturity has a lot of advantages. And if you look at data over a long period of time as to which one usually wins the day, long-term maturity floating rate debt is generally more advantageous than fixed rate debt. It's financially going to be more advantageous, except in times when you have this black swan event happen. Now, if I were buying today, would I go fixed or floating? It's going to be a surprising answer. I would probably go floating. And that's because if rates trend down, yield maintenance penalties on fixed rate debt is going to become astronomical. You're going to be locked in at the top, and you're going to have massive yield maintenance penalties. It could prevent you from selling or refinancing, or would suck all the profit out of your deal. And that's the flip side risk. And the big challenge that I have right now is floating rate interest rates are actually higher than fixed rate interest rates right now. So it makes acquiring make almost no sense, because locking in debt at the top doesn't make sense. Paying more for your interest than a fixed rate doesn't make sense. And the overall rates don't really make a lot of sense, which is part of the reason why we're sitting on the sidelines.
That's definitely an interesting perspective. Brian, can you shed some light on where we are? So let's say, I know it's easier to always say, oh, in hindsight, you obviously should have done fixed, right? But you just made a point, right? If you're trying to actually sell, the prepayment penalty is going to be huge. Can you just explain yield maintenance a little bit, just like high level on why it would be so significant?
Yeah, yield maintenance is a prepayment penalty concept that basically is guaranteeing the lender that they're going to get all the interest for your loan. So let's say, for example, you take out a 10-year loan, and this is just general broad overall terms. The nuances are a little bit more fine than that. But if you take out a 10-year loan and you want to pay it off in 2 years, you basically owe the lender the remaining 8 years of interest that you're not paying them. So that could be millions and millions of dollars, or tens of thousands, depending on the size of the loan and the amount of time left from when you paid it off to when the maturity is. So let's say, for example, right now, you buy a deal with a 10-year fixed rate loan, you lock your interest rate in at 7.5%. You're guaranteeing that lender is going to get 7.5% interest. Now, in a low rate environment like we were in, let me go back to that. You can mitigate some of that by buying treasuries. And this is the way it's done. Basically, you buy treasuries that have a maturity the same as your loan maturity when you pay off. So let's say you take out the 10-year loan, you want to sell in year 2, you owe 8 more years of interest. So you take this money, you buy these, they look at the amount of treasuries and what the treasury rate is. Let's say treasuries are at 2% and your interest rate was 4%. Instead of owing them 4% for 8 years, you're going to owe them 2% for 8 years, because they're going to take your payoff money and they're going to buy treasuries, and that's going to pay the 2%. You're going to have to pay the other. If interest rates are 7 and then interest rates decline to 2%, now you're going to owe 5% for 8 years. Now, the reverse is also true, that in that 2% environment, if interest rates go up to 7, what can happen is they'll buy the treasuries at 5 and your interest rate was 4 and they're actually money ahead and your yield maintenance payment is 0. In a rising rate environment, you can avoid yield maintenance. But do you really think rates are going to rise from 7% materially? They might a little bit, but materially, do you think they're going to get from 7 to 11? I don't think so. But could they go from 7 to 5? They very well could. And in that case, your 7% loan for 10 years that you pay off in year 2 is going to have a mountainous yield maintenance prepayment penalty.
It's interesting. I think these are the conversations it's important for investors to actually understand, because on the investment offering memorandum, it's one line. It'll just tell you fixed or variable, blah, blah, blah. It's these nuances that investors need to have a conversation to make sure that the operator fully understands that they actually have the right financial product to the business plan.
That's right. Or they're holding it all the way to term. If it's a 10-year loan and it's a 10-year hold, you know you're going to be holding that thing for 10 years because you can't pay it off in year 3. And in some cases, that's fine. But I'll tell you what, if we had bought the properties that we bought in, let's say, 2018, we had properties we bought in 2018 that we sold in 2021 for double what we paid in 2018. If we had fixed rate loans, we would not have sold those properties because our yield maintenance would have been so high that we would have just said, you know what, screw it. Rather than paying millions of dollars in yield maintenance, we're just going to hold on. So we would have held on, and guess what would have happened in 2022? The prices would have plummeted, and we wouldn't have been able to sell it for double anymore. We would have been stuck with it. We would have ended up having to hold it for 10 years. And maybe we could sell it now because we wouldn't have yield maintenance because rates went up, but also the value tanked. So having the variable rate debt allowed us the opportunity to have an early sale and produce a great result for our investors. You lock yourself out from that opportunity if you get fixed rates. So especially right now, if they do fixed, you're going to hold it for 10, fine, but just know you're not going to get that big 3-year huge payday from some fortuitous event where prices went up and you got to capture that. You're going to be holding it to term.
And there's also the assumable component with the fix. Sometimes it works out, but sometimes if you're getting it at 7, who
wants to assume that? If rates drop to 5, does anybody want to assume your 7% debt? And the problem still works in reverse. Right now, there's deals going out going, hey, we have 3% fixed rate financing you can assume. In a 7% interest rate environment, you're going, wow, that's amazing. That's great. But what you fail to realize is it's 25% LTV, and now you got to come in with 75% capital, or you got to get a supplemental loan, which is going to cost you 9%. And when you blend the rate out, it's okay, but not great. There's no free lunch.
Got it. I'm gonna open it up. We have 5 more minutes left. I just want to see if anybody have any additional questions. Feel free to ask. Brian, while we wait for any questions, why don't you tell them where we could find you? Maybe even a plug of where they can find the book, and and how can they reach you?
Yeah, sure. You can find me through our company's website. My company is Praxis Capital. The website is praxcap.com, which is praxcap.com. You can find me on Instagram at Investor Brian Burke. You can find the book on Amazon, or you can get it direct from the publisher, which is Bigger Pockets. So it's biggerpockets.com/syndication book, or biggerpockets.com/store. If you buy it directly from them, you get some bonus content that you don't get if you order from Amazon. So it's a good idea to order from them if you can. It's also available though in audiobook and so on and so forth. But yeah, those are pretty much the best ways to get a hold of me.
Look at you, Brian. You use AI in your business and you're on the gram. You're a modern day Renaissance.
I don't know what's happening to me. Something must have came over me.
All right, let's wrap it up. I'll be respectful of your time. I know it's Pacific time, right? So it's the end of the workday. So thank you so much, Brian. And for whoever's listening to us, this is another episode of the SIH Capital Group monthly webinar series. We only do 1 episode a month, but we really try to focus on high quality people to come here. And we really appreciate you tuning in. We do post everything on YouTube. So if you like what you're listening to, please feel free to subscribe. And we do break these out into smaller bite-sized pieces, so you don't have to watch for a whole hour on the replays. If there's a nugget that you like, most likely it's going to be broken up. So Brian, thank you so much for your time. Really appreciate it. And this is the second time Brian's here. The first one about reverse underwriting, strongly recommend everybody. It's an hour well spent. So listen to Brian's presentation on that. It really, he gets into the details. He brings the goods. So make sure you catch that in YouTube. Just search SIH Capital Group, Brian Burke, and you'll see it. So thank you guys for tuning in. Brian, really appreciate you coming.
Always a pleasure. Thanks for having me back.
Thanks.